Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced their earnings for the full year of 2022, and that stock is Chevron. And we can see that over the last year, the stock is down around 3 to 4% during the same time period that the S&P 500 is down around 9 to 10%. So they are outperforming the market at the moment. But over the 5-year chart, they're up around 35%. Whereas the rest of the market is up around 35 to 40%. So they're pretty much keeping on par with the rest of the market over the 5-year chart. And so in this video, I'm just going to look into some of the recent news that's come out surrounding Chevron, and then I'm going to do a discounted cash flow analysis to figure out what the intrinsic value per share of Chevron is, so we can know if this is a good price to buy into the stock from a value investing perspective. And so right here, we can see a quick little news article that came out basically talking about how Chevron has boosted their share buyback plan and affirms higher returns for the future. And in particular, they point out in their most recent earnings announcement that they're planning on expanding their share repurchase program and boosting their United States output by 750,000 barrels of oil and gas per day. They're going to increase their worldwide output by around 3% annually all the way through to 2027. On top of that, the company anticipates annual free cash flow growth of more than 10%. And basically, they're going to increase their share, well, they did increase their share repurchase guidance to around $10 to $20 billion per year due to higher expected free cash flow. And on top of that, starting in the second quarter of 2023, they're going to increase they will increase their planned annual share repurchase rate to $17.5 billion. So they're basically prioritizing returning value back to shareholders as much as possible, especially considering the fact that they anticipate higher expected free cash flow for the future. Also, this article points out that Chevron's CEO said that the gas market is fundamentally changed by the war in Russia and Ukraine. In particular, they point out that the conflict in Ukraine basically turned the global oil and gas market upside down onto its head, and it disrupted supplies coming from Russia. Europe in particular has completely turned away from dependence on Russian gas supplies, and they have no intention of changing that in the future. And then on top of that, Russian oil is still getting to global markets, but at different costs, mainly because of the fact that ships have to travel longer distances to get Russian crude and fuel to countries. And obviously that changes depending on whether or not countries have imposed sanctions or not. So a lot of changes happening in the global oil and natural gas market at the moment, and some of it might be beneficial to Chevron in the long term, but it's really hard to say, mainly because of the unpredictable nature of war and how the conflict in Russia and Ukraine is going to affect global supply chain and logistics. And so right here we can see this income statement for Chevron comparing 2020 to 2022. They've actually reported increased revenues and earnings, even though over the last year their stock price has decreased. In particular, we can see total revenues increased from $162 billion to $246 billion. So that's pretty massive growth for Chevron year over year here. We can also see that their net income has increased even more percentage-wise, from $15.6 billion to $35.4 billion. That's an increase in year over year net income by 126%. So definitely incredible earnings growth for Chevron year over year. Now we can see their balance sheet right here comparing 2021 to 2022. Total assets are up from $239 billion to $257 billion. Total liabilities are down from $99 billion to $97 billion. And we can see total equity is up from $139 billion to $160 billion. We can see their largest line item here, retained earnings, increased from $165 billion to $190 billion. So they do have more cash to distribute to shareholders and also reinvest back into the company. And then lastly, right here in their cash flow statement, we can see their operating cash flow has increased pretty consistently year over year here. 2020 was 10.5 billion, 2021 was 29.1 billion, and in 2022 it was $49.6 billion of operating cash flow. For their financing activities, we can see in terms of cash dividends paid out, they paid out about $11 billion worth of cash dividends in 2022. And I know it doesn't say it right here, but they actually ended up repurchasing around $11 billion worth of shares for the full year of 2022. So they are returning a ton of value to shareholders. And obviously, we saw from that article, they pointed out that that does seem to be one of their primary goals here, is to return as much cash back to shareholders as possible. And so now we can see this discounted cash flow model to figure out the intrinsic value per share for Chevron. Yahoo Finance, interestingly enough, as we can see right here, if I scroll down here, they are estimating that for the next 5 years, Chevron is going to grow at a negative growth rate of 8.19%. So that is the metric that I decided to use for this discounted cash flow model. But I definitely encourage everyone to do your own due diligence and use your own estimated growth rates to figure out, whatever intrinsic value estimate you think is more reasonable based on your own parameters. But I'm going to use this one from Yahoo Finance for this one. In terms of free cash flow, in their most recent full year, they had $38 billion worth of free cash flow. When you net their cash against their debt on their balance sheet, comes out to be around $10 billion of debt, and they have a little under 2 billion shares outstanding. That puts their intrinsic value per share, even with a negative growth rate of 8% for the next 10 years, at $125 per share, which compared to their current share price means that based on these estimates, they are at the current share price really only trading slightly above their intrinsic value per share. So I think that's pretty telling considering the fact that the estimated growth rate we're using in this analysis is literally negative. And even if they were to grow at a negative growth rate of 8% for the next decade, buying in at the current share price puts you at a pretty decent intrinsic value estimate right here. It's pretty much almost right there, $159, $125 per share. It's not that far off. And so right here we can see a competitor analysis. I compared them against some of their competitors, Exxon and ConocoPhillips. We can see in comparison, Chevron has the lowest gross profit margin, a middling of the pack net profit margin, lowest return on assets. They have the highest PE ratio, and they also have the highest dividend payout per share at $5.68 per share. So we can see in terms of comparing them to their main competitors here in the oil and natural gas industry, that if you're going to buy into a company based on how much value they're returning to shareholders, it looks like Chevron in the most recent full year paid out the best dividend. In terms of buying a company for their profit margins, it looks like ConocoPhillips is definitely dominating here. They have the highest profit margins and compared to Exxon and Chevron. And then they also have the lowest PE ratio, which is their price to earnings ratio. So they're probably trading at a better buy here than Exxon and Chevron. So depending on that, it depends on what you prioritize. If you want to go for shareholder return based on cash flow, it would be dividends for Chevron, or everything else, it looks like it would probably be ConocoPhillips. And to end off the video, I wanted to compare them against the other companies we've looked at in prior videos. In terms of their intrinsic value per share, Chevron came in at 5th place. They're currently trading at 1.27 times their estimated intrinsic value per share here. And so based on that, they do end up stealing the 5th place spot here at 127%. General Electric and Albertsons are still the only two companies trading below intrinsic value per share that we've looked at so far. In terms of growth rate, we saw that Chevron has a negative growth rate, so they did not make it onto the growth rate table here. But keep in mind, like I pointed out earlier in the video, it is very interesting to know that even though Chevron has a negative growth rate, they have a pretty decent share price compared to their intrinsic value per share. So if you were to use a positive growth rate estimate for Chevron, then we could be looking at Chevron potentially taking the #1 spot on this intrinsic value table. In terms of profitability, we saw that Chevron had a 21.2% gross profit margin, so they don't make it onto the gross profitability table here. Adobe still holds the #1 spot at 89%. But in terms of net profitability, they had a 15% net profit margin. So they do take the seventh place spot right behind Tesla and right ahead of Netflix. Microsoft still holds the number one net profit spot here. And then in terms of stock performance, we saw that Chevron over the last 5 years has stock performance of 35% return. So that gives them the eighth place spot here ahead of Lockheed Martin behind Albertsons. Tesla still holds the number one spot with 733% return over the last 5 years. Raytheon is in last place with 31%. So honestly, in terms of comparing them to the other companies we've looked at, Chevron is not doing that bad. They seem to be around bottom of the pack here for stock performance and net profitability. They didn't make it onto the table for gross profitability or for growth rate, but in terms of intrinsic value, they're not doing that bad, especially considering even with a negative growth rate, they managed to get onto the share price compared to intrinsic value table. In terms of competitor analysis, they're also not doing that bad. They're competitive, especially in terms of dividend payout. They're doing the best compared to their two competitors, but ConocoPhillips has the best profit margins here. So I'm not too sure what to make of Chevron. It could be a good investment at the current share price, depending on different parameters that you're using, like your estimated growth rate, and also if you really prioritize getting a dividend payout for the stocks that you invest in, then it looks like Chevron might not be that bad of a buy. But let me know in the comment section down below what you guys really think about Chevron. Is it a good buy right now at the current share price? Let me know what you guys think in the comment section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.